Welcome, welcome, welcome. Gonna get started here in a little bit. Give some people some chance to get in here. So I'm gonna actually do this open on YouTube for now, and then the video will go private later for my community access always. So first of all, if you're new around here, my name is Michael. They call me Trap, and I'm usually talking about technology, information, trading, a little bit about Amazon, and today we're gonna be actually talking about options. So the reason why I picked to do this option calls, you guys actually got a little freebie because I have a lot of new people. I ran a special for Thanksgiving. I have a lot of new people that came in, beginners and options in the trap ecosystem. And I decided to do this for them. And because I'm doing it for them, I decided I'm gonna open for the people that pull up to the live, right? And then the people that are part of the trap room in the Telegram, you guys have access to everything that I always put out. And so if you haven't been able to make it, just hit me up and I got you. Everybody else, if you didn't pull up, you missed the sauce. So welcome, welcome. You know what I'm saying? This sauce not for everybody. I mean, Saturday night, 8 o'clock p.m. You know what I'm saying? Who's home trying to learn something today, right? But anyhow, if you're from coming from the other side, my other social media, drop a little chat right there. Let me tell me that you're here. Tell me if you can hear me, and we're about to get started here very soon. Talking about started, you see this right here? That's Polygon. That 51% the past week. 51%. You see a lot of these. Virtual 22%. Render 27%. The alts are doing some numbers. It's starting to move. The alts are starting to move. All right, let me see here. Give me a second. Let me see if I can hear this live. All right, so let's get this popping. Give me a second. I gotta see this. What is going on here? Am I in the right account? Let me see. Almost there, guys. Almost there. Trying to see. I want to be able to see the video. I mean, the comments too when I'm actually live. Give me a second here. I don't think the video is showing on YouTube, so I'm trying to see if it's there. Should be on the live. It shows here. Let's see. All right, I'm back. I'm back. All right, I can see it now. All right, all right. It's beautiful. It's beautiful. It's beautiful. Let's get it popping, man. Let's get it popping. 8:07 p.m. on a Saturday. I could be anywhere in the world, but I'm gonna be here with y'all for at least an hour. I'm gonna be dropping some sauce today about options trading. Right? We talk about stocks. We about talk about technology. We talk about options trading. We talk about leverage, crypto trading, and things like that. But today I'm gonna be talking about options. And the reason for that, like I said, I'm trying to bring this information to a little bit of my community that is in crypto because this strategy here, you're gonna start to see a lot of more people copy it, right? And it would make sense to you once you understand the game. So a lot of people actually always trading crypto, they trade leverage crypto, right? So they go to exchanges and they either trade perpetuals or like sometimes crypto options. Now, the problem with that is that when you're trading in those exchanges, most of the times they're somewhere outside the United States, so you need a VPN and a few other things, right? But besides that, whenever you're trading those exchanges, they have complete control of what the prices are in those exchanges. Yo, let's get it, brother. We're here for it. Listen, today, listen, this right here, people are charged hundreds of dollars. Y'all getting the fucking sauce today. Damn, I cursed. Now I'm not gonna get monetized again. Listen, I'm gonna bring y'all the sauce today because this is for my close friends, people, and for my trap ecosystem people. So I just opened this up for the public, so I appreciate you guys, and I'm gonna give out the sauce. So like, if you don't even know what the hell is going on, like, and you learn what's going on right now, you watch it, you're gonna be understanding, at least have an idea of how does it work and everything else in between. So welcome, I appreciate y'all. So anyway, so this is strategy that I've been using for a while. It's gonna be more popular now because I already see CT, which is aka crypto Twitter, right? We call it crypto Twitter. I already see them starting to talk about it. And what that is this. I've always had a problem, right, with trading in exchanges like crypto leverage. I still do it, don't get me wrong. When we have like clear direction and we have like a break and retest situation or a pattern that is pulling out, maybe a head and shoulders, something along those ways. Don't get me wrong, I'll try here and there, and trade it. But my real bread and butter is Monday through Friday. Me and the team, we trade options instead. And the reason for that is for the exact reason that I told you before, is because exchanges for crypto, they tend to manipulate the price. So there's way more volatility in crypto than it should have, just because the exchanges know where your stop losses are. So that's why sometimes you ever happen to you where you're in a play and the exchange goes all the way down, right? Touches your stop loss and then just runs the opposite way and takes out a target one, two, and three. But guess what? You're not in the play no more. Right. So the reason why that happens is because the manipulation that happens over there. Now, I'm not saying there's no manipulation on the stock market side. I'm saying that I have a little bit more control on the price fluctuation, and so I can set my expectation that way. Let me explain a little deeper. Whenever you're trading on options, right, in the stock, I'm not gonna get too deep because we have to get from the top, right? What is an option, the basics? But I'm just gonna talk about my strategy first, right? Give you my credentials. So if you never heard of me before and you're listening to this video, you understand why you need to listen, right? So what I was saying is that once I'm able to trade options with similar leverage that I get in crypto, it makes less sense for me to go get more risk there, right? Get liquidated, fluctuates a lot more. There's no insurance or anything like that. I'd rather take that risk and trade it Monday through Friday in the stock market with options, calls, right? Or even buying options, selling options, right? Or buying some leaps. And I tell you what, most of the people on the internet don't even talk about buying options, selling options. They just talk about buying options. You feel me? Like 99% of the people on the internet, they're talking about buying options. But you have the option to sell too. Because the same way you're buying options, some people are making money with you not hitting your strike price. Right? So whenever you're betting on these options and you don't hit the price, the person that is writing those contracts for you to buy, they getting paid. There's a couple of ways to do that, and we're gonna talk about that too. Right. So ideally, what do we want to accomplish with this video, right? With this workshop? We want to make sure that you understand from point A, as far as like lingo, right? Structure and things like that, all the way to executing a call, what to look for, right? I'm gonna have a little checklist for you guys. I actually prepared the whole thing. You know what I'm saying? Like, this is what I do. You know what I'm saying? This is what I do for a living. So when I put my mind into something, like I got a whole presentation going here. We're gonna get popping here with the sauce. You feel me? If you hear me, drop a little comment there, a little fire, a little something. Let me know. Tell me the audio is good, whatever. So I'm about to get into this house real quick. You feel me? So that's the idea, right? The idea is that once you watch this video, an hour, 90 minutes or whatever, you're gonna be able to understand how options work. You're gonna be able to understand, if you're my close friends or in the trap room, you're gonna be able to understand how the calls work. Even though I usually drop some gems here and there for you guys, I'm gonna give you an explanation of the whole thing or how I think, right? Sometimes I say half position, full position, leaving a runner, right? Things like that. At the money, out the money, in the money. Like, all these terms are something that you need to learn regardless in the beginning, right? So whenever you're learning a language, you learn ABC, then you learn how B and A together. So you gotta understand that whenever you're dealing with learning a new skill, right? You need to understand that skill is gonna take you a a plan executed consistently with discipline over a period of time, right? Equals result. Now you get that result, you analyze. Are you getting what you wanted to do? You don't. Okay, so then you go back to the data that you just had that you failed your target, and now you analyze that data. What did I do, and what can I change and adjust so that I can get the result I want? Maybe it's a tweak here and there. Maybe you have to scrap the whole thing and try something new. What I don't recommend is that you jump on mad bandwagons, right? Today you're using the traps way, not tomorrow you're using this guy's way. Tomorrow, I don't care who you listen to. Just focus on one at a time and see what works. Because at the end of the day, like what I learned from my mentors when I was starting 2020 is not what I do now. You feel me? I use some fundamental things that I learned from a couple here and there, from communities, different people, different traders, and then I created my own thing. So don't worry about having your own sauce yet. Just worrying about finding a sauce that works for you, and then you can make it your sauce later. That's what I recommend, right? There's so many ways to trade and analyze, right? There's the strap method, there's the ICT method. Some people trade supply and demand, some people trade, breakouts, resistance, patterns, right? So you have to focus on that. And it's funny you say that, because that thing right there is a cultural break, bro. That jack of all trades, a master of none, is a lie. They created that a lie because they want to keep you limited. Okay. The actual whole word that they forgot, they don't mention the second part. It's actually jack of all trades, master of none, but better than none. You get what I'm saying? So it's saying that it's better for you to have experience in multiple things than not have that and not be a master. But they forgot to leave that extra side because they want to limit you, right? But yes, ideally, whenever you're focusing on a new skill, all you need is 18 minutes a day for 360 days to put you at the 90 percentile of the people that understand that skill. All right, let me repeat that again. All you need is 18 minutes a day consistently, right, at a certain time for 365 days, 1 year, and that will put you on the like 90% of the people ahead of the people that understand that skill itself. Just like putting 10,000 hours with intention into something makes you a master of it, right? These are things that I read along the way, and I think that it makes a lot of sense because if you practice like 18 minutes of a language for a whole year every day without is the consistency, right? The knowledge starts to compound. So what I'm gonna give you here today is the sauce. I'm gonna give you everything, right? People charge thousands of dollars for this. I've charged before for this very specific workshop a couple years back, $600, right? So I'm gonna give it to you guys for the free because that's what we do here, right? We have the freemium, which is you need more extra. You come into the community because today, understand this: you don't need courses anymore, right? Courses is outdated. Whenever people are selling courses and shit like that, that doesn't make sense. What you need is access, right? Because courses now you can learn from an AI, you can learn from YouTube, other videos and shit. So like it's like a course, right? Structure. It has some type of structure. You don't need that. You can get ChatGPT to spit out a structure of a course for you to learn something. What you need is access and know-how. People to show you the way. So that's what I'm gonna do to here today, right? So I'm gonna show you the way of everything that I've have acquired, right? Exactly. I appreciate you, bro. So I'm gonna show you the way everything that I have acquired today, right? That I learned in options, right? Because when in 2015 when I was trading crypto, I started with crypto, I lost everything, right? Obviously, the thing went down like 90%, and that's when I gravitated to option, right? I took out some bread and I paid a mentor 5,000 for a lifetime mentorship, which was at the time was a gamble, and it was a lot, but the guy was good, and now today he runs a hedge fund, and I still have access to him, so it's pretty cool. So I appreciate that, but ideally is that that's why you have coaches in life, right? If you ever played any sports, right, the team needs a coach. If it's not a good coach, then you don't do well, right? So high performance require adjustments by people that have done what you're trying to do. So don't feel ashamed to pay for access or to get into rooms. Put yourself into rooms. If you don't have the bread, it's cool, right? Get into the free rooms first, absorb as much as you can, right? And then once you absorb that, then you can put that into work, right? But don't be afraid to try to get in rooms. And when you have the sources, the resource, don't be afraid to pay to get in better rooms, right? Because that's when conversations are had. That's when skills are being brought out. That's when tools are being shared, right? Those are the rooms that you want to be in. Rooms like this, people that have good information, right? That is it's definitely putting your head if you're able to apply it. So without further ado, who ready for the sauce? Yo, Zach. Well, shout out Zach, man. One of those cases. Yo, shout out to Zach, bro. Like I want to put this on the public here. This man right here, he trading with us. Motherfuckers doing freaking Amazon FBA, killing the game. Hit $460,000 worth of sale this year, this past 12 months. He killing the game, bro. Shout out. You know what I'm saying? Like that's an example of a person that listens to information correctly and is able to execute that information even after, right, the excitement leaves. And that's the difference between the people that are gonna make something out of information and some of the one. Because when you're excited about something, right? You will pay whatever the price is and whatever, you do whatever, and then after that you lose the excitement, and that's when you really need the discipline to continue to grow, because that's why motivation is no bueno, right? Motivation is no good because motivation fades, right? Motivation is like brushing your teeth. You can brush your teeth every day. You know what I'm saying? If you stop brushing your teeth, you're gonna have some bad breath. Even sometimes brushing your teeth every day, you still got some bad breath, right? So like motivation is not it. Discipline, right? And that's securing the bag is always the first thing. So before you start trading options, you need to understand that trading options is just like trading perpetual cryptos. It's just like trading meme coins. It's just like trading penny stocks, right? It's a zero or hero situation. So what you have to understand is that because it's a zero hero situation, you have to have a risk strategy, right? And some of the people that are a bit older in my community, they understand what the risk strategy is, right? How much you're supposed to risk, 2 to 5% of your entire portfolio. You gotta have two portfolio, one long-term portfolio, one short-term portfolio. Out of the short-term portfolio, you have to have an amount of money that you're able to risk, right, on plays that are very high risk, high return, like meme coins and leveraging crypto options or NFT flipping, things that are a little bit more risky, right? Thank you, bro. I appreciate it, man. You have to understand that you can, if you have like 10 grand to trade and that's how your whole portfolio, that's like your long term, that's your short term, that's everything. So like you shouldn't be getting into like $1,000 calls, right? You shouldn't be risking $1,000 at a time on any type of play if you have that kind of money, right? Because that type of risk is too much and it's usually going to break your portfolio, because if it was easy, then the whole Wall Street would do it, right? Hedge funds, the S&P 500 only returns 10% a year, right? So that's the best return up to men, right? Until silver came about and spanked everything, right? Did 150% this year. But like in a regular living situation without the simulation being cracked, right? For my conspiracy theories out there, usually is a 10% return is a decent return for the amount of risk that you take in per se. Let's say if you're buying like an ETF like the S&P 500, right? So that's not what we're talking about here today. So I just want to make it very clear that none of this is financial advice, right? This is not financial advice. This is what I do for myself, and the strategies that I use for myself is a trial and error situation, and it needs forever adjustment, right? Because it's not 100%. And although I'm good, right? I'm good. You feel me? Like I can say that, you know what I mean? Because I have results and my people know. And I'm saying I bring receipts. So like I'm good, right? But even with my strategy, I'm never gonna put a more than my assume the risk. So I have a maximum that I can lose per play. And if you're in my ecosystem, right? Half a position is $300. Long a full position is $600. So I'm usually not losing any more than $500-600. But that's according to my trading method, which comes from a $25,000 portfolio. So that takes me away from the day trading situation, right? And that's a rule. It's called the day trading rule. Okay. And what that means is when you trade in an account, unless it's a cash account, you day trade, I think more than 3 times. You buy and sell the same day more than 3 times in a whole 5-day trading period, which is about a week. You get struck for the day trading rule, and then you're like blocked for months, right? Don't quote me on the time. I don't know, it's 60 days or 90 days, but you get blocked for a long time, right? So in order for you to get above that, you need to have 25K, or you need to run a cash account. The problem with cash accounts is that sometimes takes a little bit longer for you to get access to the money. So the flipping takes a little longer. And sometimes that's good because you sometimes people be over trading. And that's another thing that you need to understand, right? Trading, although it's a lot of technique, right? It's not a science that you can bet 100% on, right? That's why you need risk. You need to be able to manage your risk, meaning like, oh, I'm gonna risk $100 to make $300, or I'm gonna risk $40 so that I can make 30, 40%, 100%, right? I think it's 5 trades now in 7 days, at least on Robinhood. I think it's 5 days. Nah, bro. You gotta check that again. It could be. Yeah, check it again. But I usually if you do, I think if you do more than three in one day, I think like the fourth time they lock you out. I think, but we're gonna check that. I should have checked that before, but
At least I'm giving you the way, like sometimes you got to learn a little bit too, but go check, double check everything that I say. And anybody on the fucking internet, you double check everything they say. You feel me? Because people sometimes might miss a thing or two. We're all humans. So long story short, let's get to it. All right, let's get to it here. And we're gonna break down everything, right? I got a little bit like maybe a little bit too excited there, but we're gonna talk about we're gonna bring this down from the beginning, right? And then we're gonna add everything that the idea, how it works. But pretty much, like option calls, let's break it that down first. So pretty much the options, they're not a stock per se, but they are like a guarantee that you have, like a contract that you have, which is an option, right? To buy that stock at a certain date and time, right? That's what options are in like simple terms, kind of, right? So some people use it to trade risky, right? Some people use to like buy, like where we do sometimes too, like in the trap we do most of it is we're buying options, right? So that means that we're betting on the stock. So think about it as like almost like a sports betting. We're betting that the stock is gonna go up or down based on whatever reason you think, right? There's a list of things that I look, apart from like being able to, I chart, I check levels, volume, and then if there's anything outside environment that is gonna affect the stock, meaning like the earnings report, any type of news, especially with Trump now doing all these deals. Every time one of these companies gets one of these deals, the companies skyrocket, kind of like we had one this actually this week that we got in. This was right here. It's Intel, right? We got in on Intel. I sent this call right here, and we got in at 45 cents per contract, which is $100, right? So obviously, if it's a hundred, it's one contract, it's 100 shares, right? So whenever you buy one contract, you have the option to buy that contract or sell that contract at the price that you choose, right? In the sometime in the future, which is the date that you choose as well. So for example, here, this is a call, right? That means that I was betting that the stock is going to go up, okay? And the name of the stock is Intel, right? So it's INTC. The strike price, which is the saying that like, oh, where do I think the price is going to hit, was 40. And then the expiration date, right, is a call. Expiration date meaning that by Friday at 4 p.m., right, this stock has to hit $40 for me to get paid or not. And sometimes you don't have to hit a $40, because if it hits $40, it has to be a little bit more than 40, but it hits there for you to get paid 100%. But you don't have to hit 100% base hits all the time, because the people that are here chasing that fast, that all the time, they want to hit 800, 300%. That's the ones that end up losing. And then you get discouraged and then you leave, right? Because making money is boring, right? Don't let this internet people tell you otherwise, right? Yes, sometimes here and there you're gonna hit a lick, but in business, in life, in everything, in relationships, in real businesses, in trading, in investing, everything takes time. And yes, let's say even on Amazon, I need to sell things that maybe don't sell a lot, right? But I need to sell a lot of those to get a few dollars that pays the bills and keeps the lights on. And then we have two or three items that sell crazy, and that's where you make the money, right? So the same thing goes for stocks, the same thing goes for crypto, the same things for your relationship. You have to focus on 20% to get the 80%, the 80-20 rule, right? Focus on 20% signal, right? Kill 80% of the noise, and even one of those hit, it tends to pay or put you a break even on everything else. For example, this thing right here cost us $45 per contract. That's what it says right here. See where it says bid and then it says ask. And don't worry, I'm just gonna overview. I'm gonna break all this down, all this shit, all the means. I gotta stop cursing in these videos. I gotta get used to it. Eventually, I want to monetize my channel, but for now, I don't care. YouTube don't pay my bills, so this is bootstrap. Thank you. Shout out Trapiversity one time. So look, $45, right? I mean, $45. Why? Why, Trap? Because it says 45 cents there. For 45 and 40 and 46. Yes. The bid is 45 and the ask is 46. So that means there's some people selling that contract for 45 cents and making $45 for every 100 shares that they put at that price. And some people are buying it for 46. So usually you want a tight one there. I'm gonna talk more about that later. You want that number to be tight, right? So that you're not too far off. And always remember that this number is always going to be times 100. So even though it says 45 cents here, each one of these contracts are going to cost you 45 to $46. Okay, now we put this contract here out. We got in and we smacked it like I think same day or like the next day in 24 hours, like 67%. And then this thing spiked 800%. We did 800% in like 2 days. So it's insane, right? So that's the thing about options. So even though you guys won't have the same results as me, even if unless you take all my calls, right? Because sometimes sometimes you might take a call that doesn't do well. But ideally, what I'm trying to tell you here is that you don't have to hit every time, right, to be profitable, right? And what I'm telling you here is that you're not gonna hit 100% all the time either. So don't expect that type of result. What I am telling you though, right? Because I don't be capping. What I am telling you though is that if you have the discipline, you have a strategy that you can keep for 90 days, right, and adjust it, you could get some results that eventually will be decent results, right? I'm not saying 100%, but I'm saying that there's an extra money that you can make, right, a week if you're taking 3, 4 plays of this with discipline and you have decent money, right, guys? Because let's be realistic, bro. Like sometimes you guys, I'm not saying nobody here. I'm not. Don't take this personal, but sometimes I get people in my inboxes and they're like complaining about losing $100, and I'm like, dude, bro, like I hate to say this, but like if that's all the money you have, you shouldn't be taking this calls, like, and you shouldn't be trading. Like that $100 should be going to like maybe education, maybe like paying down some type of like making you better, right? Because ideally you want to make yourself better first, because if you make yourself better, then you can exchange that better for more money. And then once you have some money left over, that you have the ability to gamble, because at the end of the day, it's a gamble. Sports betting, options trading, crypto, even stocks, right? Even though it's a little safer because it has insurance and all that stuff, it's still risk. Investing in general brings risk. The answer to your dreams is how much risk are you willing to take and what strategy do you have? Because a lot of people don't have a strategy. And that's the problem. Because Mike Tyson said, right? Everybody has a plan until they get punched in the face, right? And people laugh about that. And they're like, yeah, it's funny. But it's even worse because 90% of the people, the NPCs walking around, don't even have a plan. Some people are trading, don't have a plan, right? So that's the problem. And then the second thing is this. Let me give you guys I like telling stories so you can kind of like let ideas sink in. Put it like this. What if I told you right now that I have Mike Tyson right here and I paid him and I'm gonna to be here with you guys and I'm gonna pay him. I'm gonna pay whoever gets in the ring with Mike Tyson and goes on toe with him and doesn't get knocked out, right? I'm gonna pay you $1 million. So the first day that line's gonna be around the corner. Like everybody's gonna be trying to not at least go toe to toe and stand up a mic. Gonna take a couple beatings, and you're gonna see people getting knocked out. And some people are gonna go back in line and try again. But some people are gonna say, forget this is impossible, and they run away. Right. But the people that end up getting back in line, back in line, back in line, they create some type of resilience, whether it's mental or physical, that eventually they might not be able to knock out Mike, but they can stand in the ring with Mike in some type of circumstance. And those are the people that make it, right? But you gotta have a plan, right? And that's what I'm gonna talk about today, mostly here, right? So this is the call that I said. So even if you miss a couple, if you get a couple of the ones that do right for you, you end up making decent money. Okay, so let's go back to the presentation. So pretty much that's what options are. So think about it like say let's say there's a house for sale. Okay. And although you don't have the money to buy the entire house, you have some money to put down as deposit. So for the sake of the math, okay, for the sake of math, we're gonna say that the house is worth $1,000. Okay. You don't have the $1,000 to pay, but you have $200 to pay, and you're betting that by the time you get to sell the house, because you don't want to keep the house, right? I sometimes there's different strategies, right? Some people buy options as an insurance to hedge their portfolio. But the options that we're talking about today is the one that you're gambling, right? Like you're betting to make some money, some extra money, right? So those options, you're literally betting that the price is going to go up or going to go down. And that's why I'm giving you the house example, because it's a similar way. So if you like want to flip a house, but you don't have the money, some people do that on the internet apparently, right? You go to a person that's selling the house for $1,000 and say, hey, listen, I like to buy your house, right? But I don't have the money, the full money right now. I want to run an inspection. I need a week. How about I give you 20,000, I mean $200, okay, which is 20% down. And from that, we sign a contract and you give me 15 days, 20 days, whatever terms you want. so that I can come up with the rest of the money, right? Now, there's a lot of intricacy that goes into the contract writing, but just for the sake of it, let's just go with that. Now, you're betting, right, that you can at least sell the house in 15, 30 days for the $100, for the $1,000 that you're paying, right? The $200 you're gonna get back, but you want to be able to sell that for 1,200. So not only get your the $1,000 you got to pay the landlord, but 200, and that's how exactly how the options contract exists and work, right? You're saying, hey, Nvidia is gonna. We were saying right there, Intel was gonna hit $40 by January 9, and even if it doesn't hit $40, you can still get paid because you start getting paid from the time you come in all the way to the actual price, right? So when you hit the $40, you're actually at 100% in the money, right? So it gets a little bit clear later, but just for now, understand it's kind of like same thing as ticket scalpers, right? They buy the things, they buy the tickets for a certain price, and they have to sell it before the concert starts. If the concerts, the closer you are to the concert, the cheapest it goes, right? Same thing happens with options. Options is the closer you start getting to the expiration date, the less is worth it, right? And the further you are to the target, it's more expensive because you have more time to get there. Okay, so just think about it like that. I gave you multiple examples of how to think about whether you're buying a house and flipping it to get an extra money on top, or whether you're scalping a ticket that you buy and you're reselling it, right? When you sell it, the time you sell it, the price you sell it, right? Those things all affect the option per se of the ticket or the house, right? So think about that, but for stock instead, right? So you're leveraging, and the reason why you're leveraging is simple. One contract of that Intel was $45, right? Because it's 45 cents times 100 shares. So that means that I'm betting that by January 9, right, I want to buy 100 shares at $40. And I'm willing to put down now $45 for that. Because 100 shares will be $450. But you don't got to pay the whole thing. You pay a percentage to get there. And that's the beauty of it, because at the end of the day on January 9, if I don't want to share the if I don't want to get the profit, I own shares, and I get them for half of the price, right? So the price that you pay for the strike, whether it's a put, meaning your betting is going down, or as a call, that day you have the option. If you're right, you have the option to either collect the money from the market, or you can actually buy the stock at that price, which is a good thing too. And that's why I told you some people use it for insurance. Because let's say I want to buy Netflix shares for $80, right? So I'll buy a put or a call at that price. And if it gets to that price around there and it executes, worst case scenario, I own the shares at that price. Now, if it drops more, I lose some money. But if I goes in the future and now Netflix is 140, I made $60 from the ability to buy that contract when that price strikes. Does that make sense? Are we in? Tell me a little bit. Drop a little emoji there. Tell me if this is making sense so I can move on to the next part, because you need to understand that part first, right? You need to understand the foundation, right? So, an option contract, nothing more, nothing less. The contract gives you the right, but not the obligation. Meaning you have the right to buy it, but if you don't want to, you can sell it to the market. That means because if you're right, the market would always absorb it, right? Some people are saying, "Oh, but you know how about who's gonna buy it?" The market. If you're right, Papa, the market always gonna take those calls at four o'clock that Friday. Okay, so don't worry about getting paid. They're efficient, and there's money in there. That's why I trade there. So that's that strategy that I told you that most people are going to start copying, the crypto traders, right? So you heard it here first. We trade options, right? That's the highest risk we take in. And then from those option profits, we put it into either memes, right? Or any other leverage situation that is high risk on there. Because if we lose it, we're losing profits that we already made there. Right. And if we win, now we have more time because we're actually buying the assets. So when you're swinging or you're buying these things, you can have a little bit more time. It's not like options that if the contract shows up in 1/9, January 9, if you buy a contract, it says expiration January 9. If you're not right by that day, $0. If you put $400, you put $40 by that day. If it doesn't hit the number, you lose all your money, right? And that's why it's risky, right? Very risky. It's high risk, high return situation. But anyhow, that's one of the things that are important for people to understand, you don't have to buy the options that day for that price. You can sell it to the market as long as you are correct in your prediction, whether it's a call and you hit the at the in the money, or is a put right in the money. And don't worry, I'm gonna explain what in the money is. We're gonna get to all of it. I promise you. Even if some of these things are sounding crazy right now, promise you, by the time we're done, you're gonna understand this, and you can watch this shit a couple times. Don't worry about it. Right? So every option contract controls exactly 100 shares, exactly like I said, right? You pay $45 because it's 100 shares. So that's why each share is 45 cents. You control 100 shares, one contract for every contract, 100 shares, right? It's standard. Everything trades like that. Unless there's other things too. There's mini contracts, there's futures, there's other things. But for options trading, whether you're buying options or selling options, whether it's now this week's expiration or a year in the future, which we call them leaps, it's okay. You still function the same way. Now let's make this concrete with Apple stock trading at 200 per share. So here's a little example for you guys to understand again, right? So if you're buying 100 shares, right, of Apple at $200, that costs you $20,000. So you have to cough up $20,000 right now. And if the share goes up or down, that's your problem, right? But what if I wanna control 100 shares of Apple at $200 price, but I don't want to put up $20,000 right now? Well, you can buy an option, right? You can buy an option, say, hey, I want to buy an option at $200, right? And I want to buy one contract that's going to give me access to buy 100 shares at this expiration date. And you might just pay $500. It depends, right? Depends how strong the company is, right? The stronger the company, the more expensive the contracts. And that's one of the things I do for my people, bro. Like for the people that are in the close friends and in the trap room, I put a lot of option calls out, and I'm always aware that you guys trade with less money. So that's why I always try to find decent contracts at $40, $50 because I trade contracts that are $200. Nvidia contracts, Tesla contracts are $600 a pop, right? So like I try to be cautious to get you guys to learn this thing. And if you do lose money, you're losing $40. But some people still lose their minds when they lose $40. Like, dude, that's no disrespect, but like trading's not for you because you're paying tuition, bro. Like at the end of the day, like you get a strategy and you pay the tuition. Just like if you go to school, you gotta pay tuition. You gotta buy books. You gotta invest in tools that are gonna do make you do better or learn better in school. And this is the same way. So I don't understand why people want to make money without money. Like that doesn't work like that. Everything takes money to make money. You know what I mean? So like if you don't have money, that's okay too. That's what I'm saying. Like you don't gotta jump around. If you don't got the bread, that's cool. Just change your strategy, right? You can paper trade options every day. Every day, if you're in my close friends and you don't have money, you could be paper trading every option and seeing exactly how it works. Meaning that if you download like Thinkorswim, which is I don't Robinhood don't have, I don't think you can paper trade on Robinhood, but you can do it on Thinkorswim, right? Is a software you download that you set it up. When you go log in, is actually if you want to trade a live account or paper trade, right? And it allows you to do that. And you can plug in the options, you learn how it works, you see the results, right? So it really takes a little bit of effort for you to get to the next level, right? So I'm giving you the sauce here of what you need to do, right? So either if you have money, you trade and create a strategy that I'm gonna give you mine here. You use whatever you want. But if you don't, then you need to be paper trading, right? So that you can at least learn on the way. You can't just be like, oh, when I have money, I'll learn. No, you got to learn now so that when you have money, you don't have to lose more money, right? So either way, I'm telling you that you can have the option to buy a stock in the future or short a stock in the future, right? For a fraction of what you had to cough out if you were to buy the actual stocks. So that's what I was trying to explain here. So this is leverage in action, right? Pretty much kind of like the leverage that you see on like perpetual trading in cryptos, that type of leverage, right? And the same thing like forex, right? When if you trade forex, like if there's 500x leverage type of deal. So very similar options or futures or leaps. These things are all leverage ways of trading these stocks, right? So I'm gonna keep going here, guys. And if you have like questions about it, just drop it in the chat. Okay, I'm watching the chat here like a hawk to see if you guys are saying something. Yeah, so if you have any questions or if things are a little bit confusing for you, just let me know. And if you're watching this video, you know how it is. Drop in my DM, you know what I'm saying? Let me know what confuses you. I'm here for the people. So long story short, calls, option, put option. It's only up and down. There's only two ways. You're only gonna go up or you're only gonna go down, right? If it's a call option, it gives you the right to buy 100 shares at the strike price. So these are some of the lingos you gotta understand. Whenever I say strike price, that means the price that is gonna be the stock, the date that I'm choosing, right? Whether it's up or down, I'm choosing that price. That's called a stock, a strike price. Okay. Essentially, you're making a bullish bet, right? When you're saying a call, bullish. And for those guys that don't understand, the concept of bullish or bear came because bulls, when they attack, they go up like this, right? So that's a bullish move. It goes up. And the bear, it claws down. So that's a bear move, right? So that's why the market calls it bear or bullish. I don't know if you knew that, but that's that barbecue talk we got going on here. So anyhow, so a call option is a bullish, right? So if you're betting that it's going to call, that means you're betting that the market is going to have an up rise, right? And so, example, $200 Apple Store trading, you buy a 210 call in the future. You're saying, I believe that before or at this time of this contract expiration, Friday afternoon, 4 p.m., I believe that Apple is going to run $10. And how do I know that, Trap? It's just like I'm pulling that out of my box or something. No, chill. That's when that's when analysis come in, right? Analysis, chart analysis. There's chart, you chart, and that's how you get the strike price, right? You figure out what levels are you trading. Are you trading today to get out of this week? Are you trading for a couple months? Swing trading, right? Are you day trading? Are you short term trading? So like, there's things you have to establish before you get into any type of place. Kind of like sometimes I see people trading and they're using skills of like meme trading coins, and they trying to trade like option stocks, or like maybe like, you get what I'm saying, like they're using like, almost like playing basketball with soccer skills. It's like, dude, you gotta adjust. Like every game's different. If you're trading options one game, if you're trading leverage cryptos another game, if you're swing trading is a game, if you're trying to swing short term, if you're trading short term, day trading short term, or swing trading, it's all different. So you have to understand all that. I'm not gonna complicate it. I just want you to have awareness, right? So like usually when we get in on these calls, most of the time they're the expiring at the this I never try to get, if I'm getting on the call after Tuesday, it's usually I'm getting for next week or further in. I like further in because I have a little bit more money, so I can wait for the swings to happen, right? So I like to pay a little bit more or find things that are cheap that people have not jumped on, right? That's how we got that Intel call. We owned that Intel call, I think Monday. The market didn't jump in until Wednesday, and then dropped again, and then on Friday ran up again to 10x, right? So like most of the time we are trading breakouts, right? That means that it broke out of like a resistance with some volume and then retested and is running again, or we're trading like I like to trade head and shoulder patterns too. They're very very good. So for now, just understand that a call is you're betting that the stock's going to go up. Strike price is the number that you're trying to bet on, right? And understand that one contract gives you access to 100 shares that you have the right to buy, but not the obligation. That's very important. If you don't want to buy, the market pays you out. That's the beauty of it, right? And not only you can buy calls because a lot of risk, but you can actually sell calls. But in order for you to sell calls, which I'm not going to talk about naked calls, it's very dangerous. I'm going to talk about covered calls that nobody on the internet talks about that. And what that means is that if you have 100 shares of any stocks that have options, you can rent, you can put out a call, either a call or put, right, saying like, hey, if this stock hits this much this week, I'm gonna sell it to that person that bought that option contract for that price. And the way you win there is that you buy over and over dollar cost averaging shares, right? So you start buying Netflix share for say, and you're buying 10 shares, 20 shares. When you hit 100 shares, right now, instead of just holding those shares, you can actually rent them out and make money, not only from dividends, but actually writing out option contracts, which I'm not going to get deep here. I'm just going to open up your mind that the risk in options trading is higher when you're trading buying calls than actually selling them. The only thing is, in order for you to sell them, you got to have a little bit of bread because you have to have 100 shares to do it the right way, right? And ideally, you want to have the shares. Let's say 100 shares. If you buy it all the time, you're gonna have a decent price. So let's say I have 100 Netflix shares, and the shares right now at Netflix are 130, but my actual price of all of them divided by my median average price is 90. So I can sell $100 strikes, 120, 130. The closer you sell to it, the more money it pays you. Just like I told you before, right? When you're buying a contract, the closer it is to the strike price, the more expensive. So you actually get that money on Friday. If I put $500 and I'm buying the call, and you put sell, you have 100 shares of Netflix, and you're selling me that call that I'm buying on Friday, me or you are gonna walk out with that money. That on at the day, the strike price and the expiration date, when it gets to that day, either I'm gonna give you all my shares that I've been buying at a certain price, or you're gonna walk out and leave me whatever you pay to get in the options call, right? So let's say that, let's use that one as an example. If I did one contract, that's $45 on the Intel call. On Friday, if that number 40 did not hit, I'm that $49 goes to whoever has 100 shares of that Intel that wrote that contract. I don't know if that makes sense to you guys, but that's called selling options, and that has less risk, right? And it's more profitable than buying options. And that's why I tell people, right? My people that are in the trap ecosystem, I tell you guys, listen, if you don't have the bread, at least 5 racks, you need to start building until you get 5 racks. Because until you get 5 racks, you're not gonna make a difference. You're gonna be struggling, you're gonna be blowing up accounts, and it's just not gonna happen, right? So how do you do? Take plays that are a little safer. If you're building your portfolio, you shouldn't even be doing options to begin with. And I'm gonna be the guy that tells you that, because I'm not here to sell you any options, right? I'm saying I'm here to show you how to do it if you are gonna do it. But like technically, if you're building the bag, you're not doing this. You're not taking that kind of risk. You're doing swings, right? You're buying stocks when they go red, like you have market shit again. You take it, and then it's all time high again. Again, the stock's all time high. So you take advantage. Whenever we're in a bullish momentum, the dips are always opportunities to make money. So if you don't have a big portfolio or a lot of money, then you want to start with things that are safer. Why are I calling those safe? Because the stock options, when it gets to the expiration date, is it a hit or miss? It can go to zero. If you put $500, it could be a zero. That's the problem. But if you're buying the stock and it fluctuates in price, as long as you don't sell, you still own an asset that can appreciate back to whatever value if it's a good company, and you can sell options on those as long as you get up to 100 and earn money while you wait for that to come back. If that makes sense, and that's crazy. So look, the put is exactly what I'm talking about for the calls, but it's actually you're betting that the stock's gonna go down. So you have the right to sell 100 shares at a strike price, right? So I say, hey, Apple's $200, but I want to sell $190 put because I think Apple's gonna go down based on my chart activity, right? And I'm gonna do a chart here in a little bit too, so that you guys can see how I picked that call for the international for the Intel call. All right. And then so that's the put, right? So you're betting that the call is going down. That is a put, and you got to keep that in mind when you're betting. Like I explained to you guys, the strike price is the price that you're choosing to bet on, right? So in the example that we just gave you, oh, I think Apple's gonna hit 210. They open and close same days too, but like most stocks are usually Monday through Friday. So you buy the call and it closes on Friday usually. All right, so expiration date, I gave you that. And then the lastly, right, the premium. That's how much you're paying, right? So the premium shares, that premium was $45. The example I use here is 320. Strike price, the premium is this, right? So whatever, because there's a buy and sell, buy and sell. So there's always going to be an imbalance here. So it depends on how much you pay, how much you get filled in. But ideally, you want to pay somewhere in between, right? You want to pay the 45 and a half or 46 or 45, the worst, right? So ideally, that would cost $45 per every contract. 10 contracts, $450. But that thing did 9x. So $450 would have turned into 4,500 here. If you have buy the contracts, once we're in the money, we take our initial money out. We raise the stop loss, which I'm going to tell you guys what it is later, and we'll continue to ride. But we leave a couple of things called runners, right? Which means that hey, we already hit some profit. We got our money out. We made some money. Now I'm going to leave one or two contracts, depending on how many I bought, and I'm gonna put a stop loss on how much I want to, like. Okay, if I made 100, okay, I don't want to lose more than 50, and I don't want to break even either. So I'm gonna put a stop loss at around 50. And if the stock keeps running, which this one did, it went to 800%. You're still making money. But if it goes down, it doesn't run, it stops you out, and then you're still in the money. So that's a good thing that you do, and that's the premium, right? The premium is what you're paying per contract uh, for having the option to own the contract here in this case of Intel. So how the options make money? Tell the truth, they really don't make money because they don't they don't produce money, right? Like I already explained to you guys. Somebody's selling a contract because they have the options at a cheaper price. So that means if I'm selling Apple shares and you're buying the $210 or cheaper, right? Because they need to make money as well. So if they have it, if they bought it for more than 210, it makes no sense for them to sell that contract for 210. But so usually that spread, that's the value, right? Intrinsic value and extrinsic value. So let's explain which one of those. So the first one, right? It's a math. So if Tesla's trading at 250, you own a $200 call, the intrinsic value is $50 per share, right? So 5,000 per contract if you have, you know what I'm saying, 100 100 shares, right? So that's pretty good money. Uh, then out of the money options have zero intrinsic value, right? Until people start looking for them, right? When you're buying out of the money, you're the first people exploring there, right? And that's why volume is important and open interest. We're going to talk about that later, right? Open interest is how many already people own it for a few days. And then the volume is how many people got into that option that day. That's why when we're trading options, if you're in the close friends or the trap ecosystem, I tell you guys, right? Always look at delta. I always look a few things easily. Those things are non-negotiable, right? Delta, theta, right? Volume and open interest, right? Along with ranges based on the chart, things you want to look for. And then the extrinsic value, right, is the time, right? The volatility, what's the market demand, which was I just talking about now, right? What's the volume? You know, how many people are holding this, right? And you all got to worry about the reason for delta, because delta usually tends to give you a probability of how much money you're going to make. I mean, of what's the percentage of hitting. So right here, if you look right here on the bottom where it says the Greeks, delta says 0.33. That means that this stock has a 33%, this call had a 33% chance of hitting. So that means that 1 in 3 chances that this was going to hit when we got in. Over here it says 24.40 cents, 47 chance of profit, which is cool. If you don't, some people that don't know the Greeks, they go with that, right? Because they add all the Greeks and then it lowers the possibility a little bit. So they give you a little bit more of like more realistic one, right? But I always go by the delta. So this is a rule: high delta, low theta. That's what I want, right? So in this one, 33% high delta, pretty decent, 1/3 of the 100%, and then low theta, right? It's negative 0.12. And theta means the decay. I'm gonna break that down later a little bit longer, but you don't want a lower delta because the higher the delta, the less money that the contract that you're holding is worth it, and the closer it gets to expiration date, the less is worth it. So by the time it gets to the expiration date and it didn't hit, it's worthless, right? So that's why those are important. Don't get caught up on the Greeks too much. Just follow the ones that I gave you. Once you understand those that I gave you, then you can add the other ones. But that delta, theta, that's the two you want to focus on right now. We continue in the next lesson. In the money, at the money, out of the money. Okay? In the money means that, hey, I'm either already buying if the option, the 210 option, the $40 option that we talked about. If you're buying in the money, that means it's already at 40, right? And you're betting that it's going to continue to go up. That's in the money, right? It says already profitable. If you sell it today, you're making money. When you're at the money, it's near the current stock price, right? And these are the ones that hit the best because you're kind of like being a predictor and you're getting reward for predicting the correct, right? And then out of the money, that means that like it's not even close, right? The price needs to move, for you to really get paid. And I like these here because hey, and that's why I don't advertise shit like that. I mean, the people that trade with me know, like, yes, we get those often, but we also take some else and we are hitting base hits a lot. We do 20%, we do 30%, we do 50%, we do 10, not 10, but like anything above 25%, I'm shaving some money, right? So like 40% very good, 50% very decent. Anything above that, usually, is much better. But just so you can understand, okay? And then the option chain, right? Strike price, volume is important, right? I told you guys that you want to see the volume, how much open interest, right? That means that how people already have those contracts they have been holding for more than a day. The volume tells you how many people traded today, right? It says right there how many contracts traded today. More volume, right? Easier to get in and out because liquidity, right? So if there's money, you can get in and out. Sometimes if there's no money, your contract price goes down. It's no people not buying it, so it's harder for you to get in and out. So in options, one of the most important skill is being fast. That's why if you're trading options, you can't just like set and forget. Oh, just buy a contract and leave and go work and stuff. Like nah, like pay attention to when I'm sending the calls. Is here and there I'll send them in crazy hours, but most of the times it's either between 9:30 and 11, and then the power hour lunch. Sometimes I get like a call or two, sometimes here and there, between like 11:30 and like 1, something like that, and then the power hour, which is the last hour of options, like 3 to 4 p.m. That's the times, right? So at those times, I'm next to my computer. I'm in a call. I'm in there, right? So if you have money in there, $200, $100, $50, whatever it is, you should be paying attention to it because moves can happen fast, right? We can get 40% and then we got out. That's it. Bye. So understand that so that you can um, make sure that you're protecting the bag, right? Aim for that contract and then of that trade. Okay, boom. We're gonna start moving very fast here. So I explained to you the delta is how much your option price changes when the stock moves $1, right? So delta of zero point 0.5, that means that a $50 move per $1 on the stock. If the delta is 80, it's an $80 move per dollar on the stock. So higher the delta, the higher your call is gonna end up paying as it gets closer to expiration, right? So gamma is how fast your data, yeah, how fast is your delta changes as the stock price moves, right? So like delta is here, and then gamma is kind of like an indicator of how fast they move, how fast the delta is either going up or down as we get close to the stock expiration or the strike price expiration that you chose. Theta, right, is the time decay. The closer you get to expiration, right, the less that option is worth. Sometimes that's why sometimes when you buy too far in the future and you get, sometimes it's a risk too, because not 100%, because you can lose interest. And even if it's now the stock's 150 and you bought 100, sometimes you have to exercise that right to make to own the shares itself. Sometimes the data can eat it up, right? It's the silent killer of option buyers, right? So look, it says weekly options bleed the fastest. In the final week, data decay accelerates dramatically. That's why, like, if you're trading the same week, those are like very volatile. You got to get in and out of them, right? So, but if you know, that's why sometimes we do trade same week, and if we hit our target, we get out. But most of the times, we're trying to go a little further, right? And that goes depends on how what works for you. Just like I'm a bullish trader, I'm not really like if you trade with me in the ecosystem, I probably in like the past 6 months, I probably send out like maybe 4 calls that are like bearish, meaning like let's short this, and everything else is like let's swing this, let's higher. So it all depends. That's another thing a lot of people don't understand. It's gonna take time for you to see what you like to do. If you're like shorting, you like longing, you got options, you like options, you like puts. I have people in my DMs that are they're bears all the time. They always want to short everything, and then I always tell them up only, dog. You know what I'm saying? Like we're going up again, and they get upset, they get tight and stuff. But like you got to figure out what's your strategy, and then you just work on that, and then create a process that works for that. And then Vega is the sensitivity to change. So like it's the volatility, right? When something happened in the world, the interest rates are going up or down. That's like volatility. And Vega is what calculates the sensitivity. You don't have to know all that. Out of all those things, just focus on the ones on the left. Delta, theta. High delta is what you want. Low theta is what you want. And let's get it. All right. All right. So this is a couple of strategies, right? So buying options, momentum, and leaps. That's trap strategy right there. That's how we really make our money. The bulk of our money comes from that, right? And what it is we trade momentum, right? What momentum is either a break, a structure, a break and retest. We trade, head and shoulder patterns, flag, bull flags. We trade, we trade some of the ICT things like fair value gaps, and we trade order blocks and things like that. So it really depends. But buying options, the way we use is momentum, right? We trade based on what we see, with now what we expect, now what we think is gonna happen. I like trade momentum, and it's bad sometimes because the momentum can fade, right? So that's why you're not gonna hit everything. But ideally, if you have a good strategy and you can be disciplined enough to take these things over and over, you end up getting a little bit better over the years. Trust me. Okay, I started this in 2020, and it's 2026, and we still get whipped here and there, and very humbled by the market here and there. But if you have a good strategy and you adjust, you always get a little better, and eventually start to take a really good L's here and there that make up for all the other things that you paid, right? So that's the tuition you're paying, right? But selling options means you can collect money up front, right, and let the time work for you instead of against you. Because when you're buying options, time is against you. If you don't, or the person that sold that option call, because you're buying the option call, somebody's on the other side. Because there's no money creation on the stock market. Every money is just transfer from hands, right? So you're either buying or selling the option call. There's somebody on the other side of that buy, and there's somebody on the other that sell, right? So keep that in mind when you're trading options, right? Selling options is also an option, and you have one is called covered calls, right? You own 100 shares, you can sell calls against them, collect premium. If the stock stays flat or rises, right, you keep the premium. If it goes past your strike price, now you sell your shares at the strike price, which you're most likely in profit, like I said, anyways, right? Because you've been buying it, even it's $40 a week, and you sell that option call every week. That's you're getting $160 from the stock. So that's one free share every week. That's four free shares. I mean, there's one free share a month, right? So if you look at it like that, so keep that in mind too. You don't have to just take all the risk and buy options. You can actually sell them as well. And then you have cash secure puts, which is like you sell puts, and then you say, hey, if it goes down, I'm gonna pay up whatever I owe. But if it doesn't go down, I mean, if it does go down as stock melts and it hits my put strike price, then you make that spread. It's kind of like the same thing of the rent when you're selling covered calls. It's similar, but you're on the other side, right? So people are selling cash secure puts, and some people are selling calls. The same way people are buying puts, and some people are buying calls. There's two places that you can sit, okay? And then spreads. The spreads I already told you guys a little bit. You want them to be close enough, right? So the bid and the ask, you don't want to be too far apart. You don't want to have, like, in other words, like a bid for 30 and then an ask for like $1.50. That's like doesn't make any sense. You want to be 10 points or 10%. That's what I like. Nothing too crazy, right, about that. And then now that buy options, they lose money. They lose money because of the timing, right? You can't get it right every time. So sometimes you're right on the strike, you just needed an extra week or an extra day, right? It's not saying that you're wrong or where the stock is going. It's just saying you didn't have enough time for it to develop to hit that number or that strike price that you were looking, right? So that's why it says that 75% of people who lose money due to poor timing and risk management. Now, 3 to 5% is max position size. People don't like to hear that because most of the time they're trading with a small bag. They only have $1,000, so 3 to 5%, it's like $30. So like, what call you're like? Okay, you got internet. They got Intel for $40, but you're not gonna get those all the time, and you still will only be able to buy one contract. So even if you did one 8x or whatever, 8 times 4, right? You still made like $300, $320, something like that. But it's good money, but it's not what everybody want to hear. Everybody wants to risk like 100%. They want to make that $1,000 flip to 2,000, like, and they want to go like that. But it's not like that. That works. 3 to 5% is what you should be risking, because that way, if you lose, you can do that 10 times and you only lose 30% of your portfolio. You can make 30 mistakes. That means you can take 30 wrong option calls and you to blow up your entire $1,000, right? That's called risk position size, and then you have to be risk return like, you got to think about the risk return, right? So let me break this down again. 3 to 5% of 25,000, right? 10% of 25,000, 2,500. Half of that, 1,250, right? So 5% is 1,250, right? Half of that is about 625, right? So that's the 2 to 5% area that you want to talk about if you have a 25,000 portfolio. So that's how it works. Whatever amount of money total that you're dealing with, you should not be putting more than 3 to 5% of it on any given call or any given NFT or any given leverage call or any given perpetual trading, because those are high risk and they're hero or zero, right? So if you have $1,000 and you do two calls of 500 each, if you make two mistakes, you're out of your money, right? So ideally, you want to stretch your money long enough. Like, we miss all the time, right? But as long as I'm hitting more than I'm missing, that usually pays off and tends to do better for you, right? So make sure you understand that. And then 30 to 5 days, right? Time to expiration recommended for beginners. That means you don't want to go too far into your mind, and the strategy has to come from how much money you have. It's just that simple. Unless you're not trading with money, you're doing the paper trading, then okay, you got to understand. You just go, you still create like an imaginary number, and then you trade with that would be a better result. But understand that, you're gonna need a strategy to go. Now, here's my non-negotiables, okay? And this isn't like motivation, okay? This is math, okay? This is math patterns, like, this is it, right? So one bad loss erases months of gains because we're not making too much, right? We're hitting a couple hits here and there that are MVPs, but most of the times it's base hits, right? So like if you're making 40% here, 60% there, 40% here, but you take 100% loss, 200% loss, then it affects your overall profit, right? Because now you got to make that up, and then you still got to make some more just to be back on the green. So keep that in mind, right? So these are the non-negotiable rules. Okay, never risk capital that you can't afford to lose completely, right? Because if you're trading an option, you should know what's your upside. Meaning, like if I'm buying an option call, I know I want to lose $20 or $500, and that's my max, right? So you need to understand what that is, okay, when you go in, because when you're trading options, you're gonna win or lose. There's no in between. Is it a hero or zero? Either it gets to that date or earlier and you get paid, or it doesn't get there and the person that sold that contract gets paid. One of those two outcomes is gonna happen, and it's gonna happen in that date that is called the strike price and the expiration price, right? He needs to hit it. So understand that and don't put capital here that you're gonna need. And if you need it quicker, then go to shorter time frames, right? Never enter a trade without knowing your stop loss, right? It's some of the basic stuff that people talk about. And there's two types of stop loss, because I understand as a trader, nobody explained this to me, okay? So I'm explaining this to you guys, and this might save a lot of people, because stop loss is like seatbelts, okay? Nobody likes to use them, okay? That's a good analogy. Stop loss are just like seatbelts. Nobody likes to use them until they need it. Until you get in a car accident, you don't have your seatbelt and you get thrown out the window, right? Until you need it, you don't like to use it. And the same thing works for stop loss. People don't like to use it because, like, oh man, I put my stop loss, the market comes in, takes my money, and then just shots up. Okay, so there's two ways to do stop loss. One of them is a percentage, and the way that I do, because I trade with a little bit more money, is a position. Let me explain how that works. If I'm trading with $500 and I go with $500 into one play, I'm willing to lose a percentage of that. So let's say your percentage is 10%. I don't trade with percentage, I trade with position. I'm gonna explain both. If you trade with percentage and you're willing to lose 50 to 1, right? So that means you make 20 or you lose 10, right? So that way, if you miss two but you hit one, you end off a break even or a profitable in the future. And that's the math, right? It's kind of like when you're betting games. When you're betting in games or sports betting, if you lose 500, the next bet you bet 1,000. So that way, if you win, you recoup your money and put you ahead. Otherwise, if you just bet 500 all the time, you're gonna be so behind so many times that you're never gonna make up the money that you already lost. So it's might as well not even bet, right? So you have to apply the similar thinking when you're doing options as well, right? So ideally, you want to outrun your losses by staying longer in things that do well. And the way to do that is, make so I know I don't have a stop loss, but I have a position loss. So meaning that if I go into a trade with $300, I'm not putting a stop loss because I'm willing to lose $300 on that trade. That's my stop loss. That's why sometimes I get a better results because I'm willing to hold for longer because I already lost that 300. Either I won or I lost that 300. I'm okay with that when I go in the trade. And that's why I'm able to maintain a little bit more emotion. Things go red, they lose that. I don't trade with with percentage stop loss. I trade with position stop loss. So let's say the contract is $40. I'm gonna buy five contracts because that's a half position. Five times four is gonna be like $200. So I can still go a little higher, right? My half position is 300. Let's say so. Eight times four, nine times four, like 30. Yeah, like eight contracts, let's say, right? That's my half position. So I'm willing to lose $300. If I go full position, obviously I'm really into the trade, and that'll be $600, right? In that case. And I'm willing to lose all 600 or make a percentage that when it hits that percentage, you're out and you're gonna try again next time. Or you're gonna have a position size, right? It could be $50, it could be risk because it's an investment. So that if it promises you a return, the risk is involved. Position accordingly, obviously, right? Probability, risk of the trade, how much money you have, how long you're willing to stay in the trade, all of that counts. Accept the losses quickly, right? Let the winners run, and with proper profit taking. Like I said, sometimes people sell in panic and then they don't, when it's green. Okay, we're losing the $200, and you don't have to do 200. I post calls that cost $30, $40, right? You could have bought two of those, right? That's $80 that you could have put here, and instead of having a $20 stop loss, just like you can do like, okay, I'm only gonna buy one contract, and I'm okay with losing the 40 or making some money, right? So I sometimes it's a little bit better to use that way, but it depends on what works for you. You got to figure out what works for you. You apply, you adjust, and you read the data. Right now, here's a little checklist for you guys. Is the trend clear and confirmed? In other words, if I'm trading this, what's the trend that I'm in? Is that you're gonna go against the trade? I've done one when I sold the discounted close friends. I put the market to market was tanking, and I put a call there because I was predicting MSTR, which is MicroStrategy, to bump a little bit, and obviously it did, right? But people are like, "Yo, the market's down, crypto's down. Why are you getting?" That was a counter trend trade. And what that means is I was trading it because I was approaching it as if I already seen that it was gonna change, right? The trend was in that changing and it was transforming from bearish to bullish. Okay. So with that said, that's a counter trend. So sometimes that's gonna happen where you're gonna see me trade something. It's gonna be like, "Yo, Trap, the market's bullish. Why are you buying a call?" It's because in the lower time frames, I'm already understanding that the trend is changing. Okay, it's called a counter trend trading. All right, so volume, obviously you want to check volume, right? Robinhood, when I go to settings, you can trade in multiple places. I use Robinhood because a lot of people find it easy, but you got Webull, you got Fidelity, you got Shaw Swabs, you got so many brokers that allow you to trade options that is not even funny, right? And soon you're going to be trading on the blockchain too, and it's going to be 24 hours. This is going to go crazy. So volume, definitely want to make sure that you check the volume, and not only the volume but the open interest, because open interest means that volume as well, right? There's people that's already in the call. Volume means that the volume that bought that day, right, is the option liquid, right? So it's the open interest. There's people in there. People are going to be able to sell. You're going to be able to get in and out. Think about that. Do I have enough time for my thesis to play out? Remember, I say sometimes it's not that we were wrong. It's just we don't have enough time for the price to play out. It's still gonna hit that level. Maybe it'll hit it a week later or a few days later. Sometimes it doesn't hit at all for months, but it's not that you're wrong. Sometimes you just don't have enough time. That's why it's important choosing strike dates and how far they expire, right? And then do I know exactly where I'm wrong, right? So if I'm wrong, can I analyze the play and be like, oh, I messed up here, or I overlooked this, or nothing I did wrong is just the way it happened. Maybe needed some more time to play out. You need to understand that. And where do I take profit? Do you know where you want to take profit? You have to have clarity when you're trading. If you don't have clarity, don't trade. No clarity, no trade. That's going to be a little cliche thing that I'm going to start saying now. No clarity, no trade. Right? If you can't answer those questions, you shouldn't be trading because it's going to be detrimental to the bag, right? You're not going to be protecting the bag because the rule of the bags is put it back. The rules of the trap, put the bag to work. Rule number two, protect the bag, right? Rule number one, protect the bag. Rule number two, put the bag to work unless it violates rule number one, which is protecting the bag, right? So that's very basic shit that you have to do because the money's gonna grow. You just gotta make sure that you protect it so it does its thing, right? You gotta get away from destroying the money, right? So that's what I had for you guys. I hope that this make a little bit more clear for you guys on how options work, right? And what I'm gonna do next time for my people in the trap ecosystem. I already told you guys we're gonna trade live. Okay, we're gonna do a live trading options trading, so you guys can see the whole operation, right? When I get the alert, we're gonna go to the chart, check the chart. We're gonna go check the volume, because that's pretty much it, right? So let me actually show you guys here, um, on the chart what it will look like, what it looked like when I was doing Intel. Okay, right here, INTC. Okay, boom. You see this here? So Intel, I started to see the volume, but the volume that I started to see was on the 1 hour chart, right? This is the second spike. I think we caught it on Monday, I think. Let's see, Friday, January, Monday, right here. So you see that yellow candle right there? That yellow candle, let me put it here for you to see. That yellow candle right there, that's Monday, okay, 9:30 a.m. I think we got in maybe at 12. I don't remember the day specific, but I remember we got in on a break of structure, right? And that was this one right here. If you see here, it broke out of this trap box that we're sitting in, and we started to move higher. The moment it breaks out the trap box and the rectangle, that's a very strong, like, yes, get in because the trend has changed and it's going up, and that's what we're looking for, right? We're looking for that yellow line to transcend from this box right here at 38, and then it did, and it came and hit our target here We wanted to go to 42, right? It hit that there. I think Friday it hit again there. Yeah, Wednesday, no Wednesday, right? So remember how I told you Wednesday and took it down and it went down and then he pumped again by Friday. So you see it here. Look, it hit all time high. That's when we cashed out right there and we left the runner. The runner went down, 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 stayed right here on the second white bar. That was the bottom, right? We always establish two areas in the chart, right? Those are the white lines in my things are always like short-term targets or something that we're trying to get on. So in this case, was the top of the rectangle, which was exactly $40, right? So that's why we went on that number right there. Because I say, hey, if you go a 40, is either gonna get rejected because the top of the triangle, right? Either gonna hit it, we're still gonna cash out, right, at 100% because it's gonna hit and get rejection, or it's gonna hit it and it's gonna continue to go in case we're gonna get paid. And what you did here, you see, still got a rejection on the purple, right? But that rejection that it got on the purple, uh, it rejected, but it's still you had a price exploration. That's what we call. Whenever you see a wick like this on top of the candle, doesn't mean the price came up here to $42. Didn't close there, but it went there. So you could have made hella more money. And that's the people that sold up here is the ones that did 800, 500, kind of like we got in at $40 and that contract went to $45 per contract. Okay. So we paid $40 and we sold it for $450 few days later. Right. So that's what I see is these break of trends. How would I know if because I draw. I'm in chart time all the time, right? So a lot of people want to be traders, but they don't have chart time, and you don't got to complicate it with lagging indicators. In the trap we only do lines. We have some indicators. We have the RSI. We look at volume. We have the SMAs to give us idea, which is these lines right here, right? These lines right here, they're the 20 EMA, 50 EMA, 100 EMA, 200 EMA, and they're very important because whenever price is above them or under them, it tends to react, right? So very important to understand. And then these purple boxes and the trap boxes, which is the ones that I show you guys a lot of times. So the trap box will look something like this, right? If I had to draw a trap box that would be effective, it would be something here because that's where we actually broke right there, and then from downwards and upwards. So you see, this is a trap box. So I do this trap box. I create an alert whenever it breaks, whenever price breaks, either if the bounces under this bottom of the trap box, that means it's bad, right? But if it stays there like it did here, look at this. One, two, three, like it's just so strong, such a strong support that as long as it doesn't break under, even if the price explores under, like the wick is fine, right? You're still bullish because this is called the discounted side of the trap box. Okay, it's on the bottom. So from the middle all the way to the bottom, the price tends to break in there up and down until enough pressure and volume makes it go up, which happens here. And you see it because my chart, this is a good indicator I use that makes whenever there's a change in the behavior or direction, it gives you those yellows. You see these two yellows? And we broke from this area and we broke all the way down. Those arrows anticipated there. And then these two arrows anticipated the upward movement, right? Two arrows. And then I knew a confirmation when it broke out of the trap box, right? So that right there, you already know. Broke above this is going higher, right? So it did. It went above here. And then now in this area right here, same thing. As soon as it gets into these rectangle situations that are similar to trap boxes, right? But they're more important because they usually signal like areas of like that the price has been hanging compressed for a little while, right? And that's usually where people go, like the algorithms go to remove liquidity, to liquidate people. So long story short, right? This is the weekly, but whenever we're trading options, we want to stay in the daily. We start in the weekly, but then we focus lower because usually we're trading short term, so you don't want to look too far out, right? And you don't want to look too low either, except for entries, because you don't want too much noise. But yeah, 30 minutes you look at it too, the 15 minutes, right, for entries and then things like that. But I like to stay within between the 1 and the 4 because, like I said, I like swing. I like to wait for positions to happen and things to happen a little bit more than actually just jump into things. Okay, so what I saw here, and I saw it in the low time frame, in the 1 hour 30 minutes, that there was a change, right? Things were changing and direction. So I predicted that, and it played out within the next 2 days. So there you have it. I hope that I was able to, make your skills of trading options a little bit better. I went a little bit over here. Actually, not much. It's 9:30 right now, so it's about an hour and a half, like I said. I hope that this helped you guys understand and make decisions. For the community, make sure that you tap in and ask any questions you have. Let me know, if this was brought more clarity to you. And obviously, you guys know that if you're in the community and I post videos and education, that they'll make a little bit more sense now. But this video right here, you should watch it at least a couple times so that you can understand how the whole thing works. But that's pretty much it. Once you set up the strike prices like we did here, right? You guys saw it. We set up one strike price was around 42. That was the range, right? From 40 to 42. That's what we're trying to get. We say we don't know where it's gonna hit, but we're gonna go with a strike price of $40 on the Intel call, right? But it could go up to 42. That's the range we established that, right? Because by establishing that, we can put the stop loss somewhere, and it would look something like this. When I sometimes I send it like that, sometimes I don't send it like that. I just send the call itself, but sometimes it will look something like this, right? Where is go? We go here and we get a tool called a short and long. Where is it at? Right here, short or long position. So we actually went long. We went long right here at 38, and this is what happened, right? The target, the stop loss, you always put it. You can put it here in the middle of the trap box if you want to have a safer stop loss. You're gonna lose a little bit more if it hits, but at least sometimes you don't get stopped out. And then other than that, you can put it at the beginning of that candle movement, okay, which is here, right? The beginning of this yellow candle movement, which is not too crazy. Like actually, you can do like 1%. Don't go less than 1%, right? So I'll put that somewhere here, like 1%. So then I want a 3% upward movement, and that will put me right here. So this is actually a this is a great this is a great one, right? That's what I'm saying. Like this was a great one. That's why I'm using an example because we risked less than 1% to make 7%. That's a 6%, and we got actually 8 and 10%, 8 and 10x. So we're risking one to make seven here. This is why options are cool, right? Because you're risking $1 to make $7. If you lose, okay, you lost $1. Try again, call tomorrow. But if you make it, these ones, you hit it. And if you would have stayed in this right here a little bit longer, you actually could have made much more because that would have put you at a 20%. So that's a 20x if you got in down here, and then you got the leverage and everything else. But that's how it, right? So once you understand the ranges and everything else and where you're gonna go and what price, now you go with this information. Then you go to the checklist I gave you before. You check the volume, you check the open interest, you check the strike prices. How much are they charging? Is it too expensive for you to wait? Are you willing to risk that much money? Is it 300? Then look a little further. Maybe you can go a little bit out of the money with a little bit of volume and pay less, right? But you understand you don't have to buy 40. That one's gonna pay better, but you can buy 42 for much cheaper, right? And make 40% instead of 100. So it's a little bit of strategies, but overall, you guys got everything that you need to learn from learning the chart and checking the ranges all the way to what you need to look when you actually choosing the contracts for the options. So always a pleasure speaking to you guys. Thank you for your time on this beautiful Saturday night. I hope that I was able to add some value to your life tonight. If I did, make sure you support the content, drop an emoji, I'm saying, share with the friends. And you already know, man, stay trapping.